Perfect. All right. Thank you. Thanks very much, Anna. So yeah, thanks everyone for joining this session on the financing of the durable carbon removal market. So just as a way of introduction, my name is Sebastien. I am the co-founder of ClimeFi, and at ClimeFi, what we're doing is we are partnering with larger organizations, so buyer in the carbon removal markets, to help them build and manage their carbon removal purchase programs. So we sit in a relatively privileged position in that we sit between the buyers, the suppliers, but also then the investors, which is also part of the equation. So we have interesting data to share today on this topic. So what I'm planning to do in terms of agenda for this session is to do a presentation, which is going to be around 20 minutes, and covering, first of all, some of the key market data that we've been collecting in the past couple of months, then talking more specifically about the CDR financing landscape, where are the pain points, and then a few final thoughts around CDR as an asset class, and what is missing currently to really have CDR emerge as this new asset class and sort of unlock more global financing for the industry. If you have questions, feel free to also raise it during the meeting. I'm happy to take questions. There's going to be a lot of data, so don't hesitate to interrupt. So just to start, a brief overview of the market and where we are right now. So here we're showing the cumulative commitment on the market since 2022. And what we are seeing is a really interesting growth of the market, going from almost 0 3 years ago to over 37 million tons that have been committed on the market over the past 3 years. Now, what is also really interesting to note, which I think many in the CDR markets are well aware, but is that Microsoft is over 70% of the market. And so the market this year is almost growing 4 times, including Microsoft. But the other interesting dynamics that we are seeing is that the market is still growing relatively nicely, excluding Microsoft, so around 2 times this year, to reach around 7 million tons that have been committed by other buyers. And this reflects also what we are seeing at ClimeFi in terms of we do see sort of new market entrant, new industry, and new buyers entering. Definitely not with the same scale, but that's been a relatively positive development this year, especially considering the geopolitical environment that the industry has been in. And so yeah, that's definitely something we've been relatively excited about this year. Now, if we look at the supply side, so we just discussed that there was around 37 million tons that have been committed to suppliers. So what we have done over the past couple of months is we've run this broad-based RFP for many of our clients to secure offtake commitments. And so we've asked for the capacity between 26 and 2030 for the CDR markets. And our prediction this year, just to give some numbers, is that across all the registry, we will probably be able to issue slightly less than 1 million tons. So probably our prediction right now is 800,000 tons will be issued, across all pathways in the CDR markets. And what we're seeing here in this graph is that the prediction from suppliers next year will increase to 3 million, all the way to 23 million in 2030. So we're seeing, from our perspective, pretty interesting growth from the supply side. This is to take with slightly, with some grain of salt, because typically suppliers tend to be quite optimistic in how they share those numbers, and there's sometimes some discount factor that we take when we enter into further analysis. But still, it's kind of shows a relatively nice scale up of the supply over the next few years. It's definitely far from some of the numbers you may see, in the news sometimes in terms of where the industry needs to be. So if you look at 23 million tons in 2030, it's very far from any kind of gigaton discussion. But it is, from our perspective, a pretty good scale up from where we are today. And the other last thing I'm going to highlight is supply side, from our perspective, not going to develop exponentially. It's going to follow a relatively linear track, as this is a lot of infrastructure that needs to be put in place and a lot of investments. although you do see a little bit of that tick up in the later vintages here, mainly with BEX facility coming online with many volumes in the first year of operations. Now, the next slide, just showing a sort of break of the supply. So this is here by the number of projects in the CDR market. So you see here that biochar has the most number of suppliers. It's also the most fragmented market. But then the sort of the coverage across the other pathways is relatively, mixed. So that's quite interesting. And then in terms of geographical distribution, it's Asia and North America where we've seen the most projects emerge, then followed by Europe and Africa. This has been actually quite different from the RFP we run last year. So last year, what we have seen is actually a very overweight on Europe and US. But this year, actually, a big shift has been the emergence of Global South, with much more projects actually being launched or being commercially active in the Global South. So that pie chart now looks actually much more balanced, globally. Now we look at the same pathway distribution in terms of where the supply is, but I think from a different lens. So not by the number of projects, but by how much is being contracted in each of those pathways. And there's a few interesting insights here. So in 2026, you do see that biochar is taking the bigger part of the market here, because this is also the one that is the most mature, that has the earliest delivery. So you see here almost 60% of what's been contracted has been in biochar. And then you do see some kind of splits, between DAC, MCDR, and enhanced weathering. This is contracted, so even for DAC, there is some question mark whether all of that will, maybe deliver or not. So, but this is just disclosure in terms of, what is being contracted. But then if you look at the sort of average across 26 to 2030, I think the interesting dynamics we're seeing is that it's a much more balanced, right? As especially you see the emergence of BEX in the later vintages, which is almost at the same sort of level than biochar in terms of contracted volumes. And then you see also a distribution across some of the other pathways. So basically the bottom line is that it's interesting to see that right now in the earlier day, biochar is a big part, but as we scale up towards 2030, we do see a more balanced sort of delivery prediction based on what is being contracted today. Now here, this is the key slide in terms of the financing landscape that we wanted to highlight, which is that we're showing on the left side of the graph, essentially how much capacity is being disclosed by projects. So this is the 62 million total capacity that I have shown, if you will, earlier in the presentation, the 62 million. And then we do show how much of that disclosed capacity by suppliers has been contracted, and how much has been, where the funding has been secured. And I think the few interesting insights here that we want to highlight is, one, we do see that already 20% of the capacity is being contracted, but there is almost 40% of the capacity that is being disclosed that has been indicated as already financed. And this dynamic sort of intuitively makes sense because, and we'll talk about that later, but most of the funding today in the CDR market has come from, grants, equity. So essentially forms of financing that do not require to have all of the capacity contracted. But our expectation is that if we were to run this analysis in 5 years, you will see that gap closing as projects will go towards more non-dilutive form of financing. They will need to actually have the supply contracted before securing the funding, which hasn't been the dynamic that we have observed to date on the market. Just one quick pathway observation as well on this slide. So you see almost all the pathways here have more funding than what has been contracted, with the exception of two. One is BEX, so the bio-CCS, the second line. And the dynamic here that we are seeing is that a lot of those projects to basically validate FID, so final investment decision, they do need the offtakes and so the contracted. So that's why pretty interesting here, we see it tracking almost, percentage by percentage, 44, 45. And then also enhanced weathering is the only exception where they actually have more, volume contracted versus the funding that has been secured, indicated. And the dynamic we're seeing specifically in enhanced weathering there is that a lot of the buyers are actually playing the role of pushing the projects forward, since it's also funding. So the more demand the projects have, the more rocks they can deploy, and the buyers has played a little bit that role of a financier more than in other pathways, has been our observation. So yeah, that's it for the market data that I wanted to share. This is to set the scene around the sort of the financing landscape, but also sharing a few observations that we've made, which I think is shaping these early CDR markets. If we look at the landscape of financing in the market here, you will see that the projects are going from, when they start from lab capacity, and then they mature towards first of a kind, next of a kind, towards different form of financing that are required. So in the earlier stage, grants and foundations and equity is the primary source of funding. Also because it's too risky for the sort of later stage investors to engage. And then in the later stage, with the first of a kind and the next of a kind, this is where we do start to see dynamics of non-dilutive funding coming to markets. But right now we do see a big gap there. So as much as we do have seen meaningful amount of equity being deployed, we've seen grants, both governmental and non-governmental, being deployed in the markets. We start to hear some announcements on the non-dilutive, some debt being financed, but it's still very, very scarce. And this is when we talk about the funding gap in the market. This is usually the gap between the demonstration plant to fully commercial, where now the gap is that the projects have a little bit of track records, but not enough to convince the the investors, which are more risk averse than in the earlier stage. And so what we have tried to map here, so our team has kind of looked at all the different pathways, and then what has been the primary source of funding in the market to date. So this is the the left part of the slide that you're seeing here. But then also on the right side, what should be the optimal form of funding for the specific pathways. And this is an estimation based on how much CapEx they need, how much OpEx they need. But this is sort of looking at what would be the optimal form of funding. And then what we are seeing, and I think with no big surprise, is that the optimal form of funding from many of those projects is actually a form of non-dilutive funding. The reason being that in many cases those projects are infrastructure, do require meaning amount of capex and opex financing, and so this is this is the sort of the transition that the CDR market needs to go through. One thing that we do start to see as well is more and more balance sheet equity. CDR projects are not only startups starting out, but more and more also sort of larger company deciding to launch projects. And in those cases, if they do have a little bit of balance sheet equity, it's really useful to kind of bridge that gap and build track records, and for the later sort of projects go towards non-dilutive source of funding. Now the next graph we want to double click on project financing, and this is a bit of a complex structure that we are showing here. I'm not going to explain all of the structure, but I want to make a point, which is that project financing is discussed a lot in the CDR market, but in many cases people mistake project financing as a form of financing, whereas it's actually really a structural agreement, right? Project financing. So it's more, project financing is really the concept of separating the projects from either the project developer or the technology developer. So it's really a concept of separation. And the reason to separate it is a couple of reasons. The first reason is that as a project developer, if I can launch your projects and get some funding for that, this is typically non-recourse debt, meaning that I'm not at risk if the project fails, right? It's really only for that specific projects. And it also makes it much easier for the investors to assess the project on its merits and not have to deal with all the dynamics that are more at the top core level, so the box that you see on the top. But the other thing that we're seeing in the CDR market right now is that separation is actually very difficult to do. So if for example, like the concept of a bio-CCS or BECCS plant that is retrofitting into an existing industry, it's very difficult to say that's going to be a project on its own, right? Or if you're a DAC developer, you need to make sure that your technology can be used by someone else completely independently, right? And so to to arrive to that stage, I think a lot of progress still needs to be made in some cases. And even with the most mature projects like biochar, for example, you would say pyrolysis is a very mature technology. What we are seeing is that a lot of maintenance is required, So even from the technology provider of pyrolysis that sell the technology, there is still a lot of interaction, and those technologies don't operate always super independently. And so I think solving that separation problem will be very important for unlocking some of the typical project financing investors active in the space. Then some final thoughts here in terms of how those investors think if you're looking for project financing. As opposed to equity investors, they cannot take any technology and market risks. This is something that needs to be solved. So technology needs to be demonstrated with track records. Market risk needs to be solved with offtake agreements. So the dynamics I shown in the previous slide, where you see the mismatch between funding and contracted capacity, this is a risk they cannot not take typically. The only risk those type of investors usually can take is the operation risks. But still needs to be managed. But that's something that based on other project financing sort of case study that you can look at, that's something they will look at. But it's kind of what they are used to. And then the other thing which I think is important is ticket size. So in many cases, for typical project financing, 25-30 million is kind of like the benchmark. And so in some cases, if you need much less, that maybe there is a discussion to be had. Should I go look towards a more local bank to finance my plant, or finding other source, because that's a bar that typically needs to be met. And then I discussed this before, but the separation between OpCo and Project Co is really important to be able to attract those type of large project financing tickets. I want to maybe say a few thoughts finally in terms of how we look at the market. And when we talk about right now, there is a bit of a funding gap in the CDR market. What is missing also in terms of the piece to say we're going to attract global capital, and what sort of mechanism we need to put in place to make that happen. So we did the exercise recently at ClimeFi to ask ourselves, first of all, where do we stand right now, and how can we integrate CDR into really a new asset class? And I think an important discussion there is, how do we integrate the carbon credits or that into existing accounting frameworks? And so here, the one graph on the right side that you can see here is this is how it's currently accounted by the company that we are seeing. So typically what happens is when a company buys carbon removals, they don't record it on the accounting side. They just disclose it as a commitment. And once they deliver it, depending on the use that they want to do for it, they record it either as an inventory if they want to resell it, or as an intangible asset if they want to use it for retirement. And it's only when it's being either sold at a loss or at the profit, or retired, that this then is hitting essentially the P&L of the company. This is right now like early guidance. I think it's going to be very important to have like formal guidance from IFRS, which is the overarching standard for accounting, and then we do see like the big four accounting firm, for example, doing more and more work there to give clear guidance. But I think that's going to be a very important point for companies to start also really building a business case around that, having some clear guideline that they can use to start registering this as an asset. And of course, if regulation comes and defines suddenly some liability from companies in terms of their purchasing needs, that's going to, of course, accelerate that whole process. And finally, the other thing that we did here is, there is a lot of discussion in the market as to whether carbon removal can become a commodity, which is, and why it's important is because, having a commodity, again, will unlock so much mechanism that can be built on top to attract funding, to attract more buyers, etc. As long as we don't have much standardization, it's very difficult to scale, globally and make that a real market. So what we did here, we looked at what are the key criteria that needs to be met, if you will, to call something a commodity, right? So it's kind of a theoretical exercise, but the two big buckets that are very important is, one is how interchangeable the unit is, and then is there a viable market? This is a two typical sort of commodity test. So when we look at the first one, so in terms of units, what's really interesting with carbon removal is that on paper it's very the fungibility is really given, because 1 tons of CO2 removed anywhere, whether it's in China, in France, or in the US, has the same climate impact. So that fungibility is there. The problem is more how we get to that tons of carbon removals, right? So the way to get there is very diverse. And see, this is where right now the homogeneity and standardization test is really not there, because we see a lot of different prices, a lot of different quality, a lot of different. So this is where the work here needs to happen, but also where regulation can play a role in saying what is the minimum sort of quality criteria that we will call it good enough, which will really help to bridge that gap towards commodity. And then the final one, when you look at the market, two tests are, whether there's really a market. I think it's right now it's very small, but I think it's getting there. So that's not really a big concern. And also liquidity, very few liquidity, but as the market scale, more and more liquidity will also come into the market. So those are two sort of markets that we feel like can be solved towards bringing a commodity, with the big one being then regulation. And this is, of course, a separate discussion that I'm not going to enter in today. But this is, I guess the outcome of that discussion is I think regulation has a role here in defining what are the rules of the game to start building a market towards commoditization. I said in the beginning that I was going to try to leave time for questions, so that's perfect. I'm arriving at the end of the conversation. The last comment I'll make is that we've published an analysis on the website looking at each pathways, how much they are, what assets they have to get financed, what are the liability that they need to be aware, and then what is the right form of financing, who are the right form of actors. So I would very encourage you, if you're interested in the topic, to go on our website. You can download the analysis that we've done, and then we'll keep trying to update this based on the case study we've seen, based on the success we're seeing in the CDR market. Yeah, otherwise I think I'm arriving at the end of the presentation. I still have 7 minutes for questions in case there are any. Yes, Anna, I think you have your... All right, I think if there is no big question, if I'm not mistaken, this session is recorded. So I think there will also be, there is one question.
I think someone is typing, yes, this is what I was going to say. One second, I'm going to give you the mic option.
And, I appreciate it was a lot of data, a little bit of technicality. So hopefully...
you can turn on your mic or camera if you want as well to ask your question live.
Perfect. Yeah, hello, Sebastien. It was nice to follow you. I was wondering what was the price of the different CO2 capture at the end. Do you have an insight about that?
Yeah, absolutely. So it's part of the data I haven't shown in this presentation, but we also had we also have a slide that you can also find in case of interest in our latest Q3 report, where we show all the quotes that we have received from suppliers and the variance that we're seeing for each of those pathways. But to give a rough indication, I think within biochar, we were seeing quotes below the lower hundreds towards up to $250, $300 per ton. In enhanced weathering, the range was roughly between $200 to $400 per ton. In mineralization, it was like $200 to $300 per ton. And then I think DAC, we were between 400 to 600, something around that range. BEX was also one interesting. With BEX, we were anywhere between 250 to 500, more or less. Just to give you an indication, so across all of the deals we've done so far in the last 3 years, in our portfolios, I think we have an average price around 200, something around that. per ton.
Okay, very interesting. Thank you very much.
Yeah, no, sure. It is something actually that we are seeing. So we're seeing two interesting dynamics on price. One is that projects are actually, with scale, being able to produce cheaper. So we do see some trends or dynamics pushing price further down. But we also see the opposite trend, especially from successful suppliers that they've sold in the last few years at a specific price. They're seeing nice market interest, and we do see them increase prices over the years. So it makes it more profitable for them typically, but it's also, we do see those two dynamics operating at the same time.
Because you're a bit in concurrence with direct capture, I can imagine, like all the projects are in concurrence with direct capture. Like how there the price is like way less, like around 100 francs per ton. Like, is it hard to convince investor to invest in technology that now is quite expensive?
Yeah, I mean, I think buyers typically will build diversified portfolio where they will consider different range of technology. They typically have a target price for the whole portfolio, but then how you construct the portfolio, they also want to make sure there's projects that are aligned with either the value chain or how they look at the market. And so in that constellation, we do see some interest even for the higher or the more expensive projects. But you said $100 per ton for DAC, or because that we haven't seen.
No,
DAC
for
typically,
not direct capture, but like at the chimney, you just capture the CO2, like filtering it, and then reinjecting it in the ground.
Yeah. Well, this wouldn't be considered carbon removals in the sense that if it's collected before it entered the atmosphere, it would come into a more sort of carbon CCS, which would be more on the avoidance side. So right now, I think the presentation was mainly on carbon removals, to as a counterbalance, to use as a compensation. We do see a strong market on the CCS side, but that would be almost separate than the carbon removal conversation. Yeah.
Okay, thank you.
All right. I think if there's no further question, yeah, thanks a lot everyone for joining. Feel free to reach out to ClimeFi if you have any question on the topic. And otherwise, if I'm not mistaken, again, I do think this session is recorded, so you can find further insights there.
Thank you all. This is the end of the session.
Yeah. Thank you, Anna. Thanks.